Hi friends, welcome back to Murthy Finance Academy. Today we will discuss few companies from the gold jewelry space. So the first company we are going to discuss is PN Gadgil Jewellers. A quick disclaimer, whatever the companies we are going to discuss is purely for educational purpose. Please do not consider it as an investment advice. Please consult your financial advisor before taking any financial related decisions. Now let's proceed. So PN Gadgil Jewellers, forget the legacy for a second. Look at the margins. PN Gadgils isn't just selling gold. They are selling trust in a market that is finally cleaning up its act. Established in 1832, this 190-year-old brand has successfully pivoted from a regional Maharashtra powerhouse to a multi-state listed force. The signal here isn't the history, it's the structural makeover. By exiting the low-margin refinery business, a revenue bloater that surpassed OPM for years, management has finally unmasked its true profitability of their retail operations. The business model is now bifurcated for the maximum reach. The core PN Jewelers handles the big ticket wedding demand, while the new Litestyle and LS by PNG segments target Gen Z with high fashion daily wear pieces. This shift into the lifestyle brand is a capital light masterstroke, as these stores require significantly lower capex than traditional showrooms. This evolution positions Gadgil perfectly for the broader industry shift. If you see the Indian jewelry sector is undergoing a great migration. According to CRISIL and IBEF data, organized retail in India is projected to capture 45% of the market share by fiscal year 2026, up from just 35% a years ago. Consumers are deserting local goldsmiths for chains that offer hallmarking, transparent buyback policies, and brand prestige. So, while peers like Titan and Kalyan have long battled in the saturated south, PN Gadgil is hunting in the central India belt, like UP and Bihar also. These regions are traditionally dominated by fragmented, unorganized players. So here Gadgil's entry into Lucknow, Kanpur and Patna represents a massive land grab opportunity. Despite gold prices surging 70% year on year, a volatility that usually kills volumes, the Indian wedding value chain has proven price inelastic. People might buy lighter gold, but they don't stop buying. So here Gadgil is capturing this via specific geography and high margin product segments. So here company is no longer a plan, it is de-risking its reality. So PN Gadgil now operates 66 stores across 5 states. So the main margin delta in UP and Bihar, the move into the north isn't just a store count play, it's a mix play. Management confirms that the inventory mix in UP and Bihar is significantly higher in studded and fancy jewelry compared to the gold heavy traditional demand in Maharashtra. This fancy preference naturally carries higher margins, because in general for a jewelry, if there is a more studded mix in the gold jewelry, then the company generally has a higher margins. So coming to growth levers, the company's e-commerce segment exploded 125.8% year on year. It serves as an omni-channel funnel where customers browse online before closing the high value sale in store. So it is also operates mostly in FOCO model. So its FOCO model stores grew 65.4% year on year. The franchise-owned company-operated model is the ultimate capital light lever, allowing Gadgil to scale the brand using third-party capital while maintaining operational control. If you see, Q3 is the Super Bowl of Indian retail. With the confluence of Diwali and the wedding season, Gadgil delivered a knockout performance. The company reported revenue of nearly 3,303 crores, which is nearly 36% year-on-year rise, and EBITDA of 271.7 crores, up by 109.4% year-on-year. And PAT also stood at 171 crores, up by 98.6% year-on-year. Operating margin jump, it leapt from 3% in September 2024 to 7% in December 2025. Look at the delta. This OPM expansion isn't accidental. It's the mechanical result of the refinery exit. Previously, the refinery business bloated the top line but offered near zero margins. Removing it has cleaned the P&L, allowing the high margin retail segment to dominate the consolidated numbers. So if you see, the company shows a negative cash flow from operations of 675 crores for March 2025. This reflects a massive inventory buildup. Inventory days spiked from 62 to 104 to stock the 11 to 12 new stores. So in a rapid growth phase, negative CFO it is not always a red flag. It is an inventory for growth trade-off. So here Gadgil is essentially locking its cash into gold on the shelves of new stores. The kicker, if gold prices drop, that inventory loses value, making the current high gold price a double-edged sword for working capital. So if you see some key KPIs, so the noise footfall is up 33%. What is the signal here? A 94% conversion rate. That means people aren't window shopping, they are entering with the intent to buy. So the company's average transaction value stood at nearly 1,03,065 rupees, and revenue per square foot stood at nearly 3,42,800, which is industry leading efficiency. The stud ratio nuance, while the raw studded ratio is reported at 8.4%, management highlighted a vital teaching point. If you include Kundan and Polki, the ratio is already closer to 10%. This means Gadgil is nearing its medium-term goals much faster than the headline numbers suggest. Management's long-term target is 13 to 14%, which would further re-rate the bottom line. So management's under-promise and over-delivery strategy is evident. They guided for 9,500 crores revenue for fiscal year 2026. They have already clocked nearly 7,200 crores by Q3 and are now projecting to cross 10,000 crores. So the fiscal year 2027 boldness, the real signal for investors is the revenue guidance of 12,000 crores by 2027. This implies a sustained 20 to 25% growth trajectory. To fuel this, they have onboarded Ranbir Kapoor and Sara Tendulkar to bridge the legacy to Gen Z gap. And a notable AR tech gap remains in this company. While peers like Titan uses data to predict regional fashion trends, Gadgil's Concall showed a lag in tech leverage. They are playing a traditionalist game in a data-driven world. Saurabh Gadgil has high skin in the game. The management is conservative with words but aggressive with store launches. They are delivering on every margin promise made during the IPO, proving the brand can travel outside Maharashtra. So if you see currently, the company trades at nearly 20 PE. So compared to that with Titan and Kalyan, Titan generally trades at around 60 times and Kalyan at 45 times. The market is currently giving Gadgil a regional discount. So 82% trailing 12 months profit growth versus a 19.5 times multiple suggests the market hasn't priced in the sustainability of the new 7% operating margins. Okay, a 0% dividend yield is classic growth phrase. Every rupee is being flowed back into gold and store fit outs. Return on equity of 25.7% nearly is exceptional for a retail player. Relative its 25% ROE and explosive profit growth, the stock looks fundamentally undervalued. If the market starts treating it as a national player rather than Maharashtra player, a significant multiple re-rating is likely. So, what are the all good things? There are no red flags. Yes, still there are red flags in this company. So, what could go wrong? Promoter overhang. Promoter holding is at 83.11%. SEBI 75% rule means a dilution overhang is coming. This might provide a better entry point, but will act as a price ceiling in the short term. And there is an inventory bloat. Inventory days have spiked to 104. This is a massive bet on gold price stability. And there is an interest capitalization. So there are potential interest capitalization which can artificially smooth out the P&L. And there is silver risk. Management admitted that silver exposure remains unhedged, adding quarterly noise to earnings. And if we quickly see its SWOT analysis, the company's core strengths are 190 plus years of trust mode, high ROC of 19.4%, and dominance in high spend Maharashtra. Coming to weaknesses, negative cash flow from operations due to aggressive expansion, high inventory risk of 104 days nearly, and low studded ratio versus peers. Coming to opportunities, capex of 70 lakhs versus 2 crores allows faster scaling. UP and Bihar Central India land grab and fiscal year 2027 guidance of 12,000 crores revenue target are some key opportunities to look out for. And the threats, SEBI mandated dilution of promoter stake, gold price crash affecting inventory value, and modernization lag could be some key threats for this company. So what are the key monitorables we need to monitor in this company for the next few quarters are Central India success rate, monitor Gorakhpur, Banaras store launches as well, which will happen in the next quarter. Stud ratio, watch for a move past the 10% mark, including Kundan or Polki. And QIP timeline, check the pricing and dilution impact of the potential fundraise. CFO normalization, do inventory days stabilize as stores mature? Next, lifestyle scaling. Does the capital light model improve the overall company's ROCE? And Ranbir Kapoor campaign, impact on same store sales growth in North India footfalls. So, what is the final verdict for this company? If I say Gadgil Jewellers is executing a textbook structural turnaround using a multi-century legacy to fund a modern, high-margin retail expansion that the market has yet to fully re-rate. Okay, so if we need to do some peer-to-peer analysis, so PN Gadgil is punching way above its weight class in terms of store level productivity. Their revenue per square foot is nearly 3,42,000, which is considered as industry leading. This is fueled by an incredible 94% conversion rate, meaning their walk-ins are higher intent buyers, not window shoppers. And if you see in the margins, Titan and Kalyan have a much higher studded ratio, which typically carries margins of 25% plus. But Gadgil's currently their raw studded ratio is lower to 8.4%. But if you include the Kundans and Polkis, they are hitting 10% with a management target of 13 to 14%. As this ratio claims, the valuation gap between Gadgil and its peers is expected to shrink. And Gadgil's lifestyle edge. While traditional showrooms cost about 2 crore to set up, Gadgil's new Litestyle stores requires only 70 lakhs. This capital light model allows them to scale much faster than peers who focuses solely on massive high capex flagship stores. And while Titan and Kalyan are battling in the saturated south area, Gadgil is quietly land grabbing in central India like UP and Bihar, where they can capture market share from unorganized local players. So the primary reason for Gadgil trading at nearly 20 PEs compared to Titan's 60x and Kalyan's 45x is simply of market perception of them as a Maharashtra only brand. So if Gadgil successfully executes its expansion into North India belt, the market will re-rate the stock as a national player, potentially leading to a significant jump in share price. So Gadgil is essentially a high efficiency machine that has cleansed its balance sheet by exiting the lower margin refinery business. So with 12,000 crore revenue target for fiscal year 27, they are positioning themselves to be a formidable challenger to the established national chains. Hope you like this video. If you do like this video, please do like, share and subscribe to Murthy Finance Academy. Thank you.